Hi, I'm Candace Schultz, and I'm a financial planner here at Aspen Wealth Management. I get questions all the time about mortgages and buying a home, so I thought we would sit down today with Matt Pruitt from Sendera Funding and pick his brain. When it comes to student loans, what are we really up against?
Student loan debt is the #1 consumer debt in the United States of America. It's a problem for borrowers that we run into every day, and we are working diligently to come up with solutions. Basically, since September of 2015, the rules were tightened. Guidelines were tightened so that if you have student loan debt, where we used to be able to have you put the loans into forbearance for 12 months after closing and ignore that payment altogether, we no longer have that option. And the rules have changed several times since September of 2015, and keeping track of them is almost a monthly project. So as it pertains to student loans, you want to stay in close communication with someone who is familiar with these guidelines. As of today, we've got a couple options when it comes to calculating student loan payments. Regardless of what your student loan payment actually is, that is not necessarily the payment that we have to calculate, that we are required to use when coming up with your monthly debt to income ratio. When I'm trying to qualify you for a mortgage, I may not get to use your actual payment, right? So, as it pertains to an FHA loan and a conventional loan, which are the two most common loan types, I'm either using 1% of your total student loan balance as your monthly payment, or I'm using the actual payment that you have agreed upon with your student loan servicer as long as it amortizes over the set loan term. In other words, if you've got a student loan payment that will amortize over a designated amount of time, then I get to use that. So let's give an example. If you have $100,000 of student loan debt, I have to count 1% or $1,000 as your monthly payment. That is going to dramatically reduce the amount of house you qualify to buy, right? However, if you have an agreed upon payment amount with your student loan servicer of, let's say, $400 or $500, and that payment will pay off the loan amount in an agreed upon amount of time, then I'm able to use that agreed upon payment in your qualification instead of the larger amount, which is an enhancement to the pre-existing guidelines. That will help you be able to buy more house. As it relates to conventional and FHA loans, it's 1% or the actual payment as long as it amortizes. As it pertains to veterans, if you have served our country, you've got a little more wiggle room as it pertains to student loans. If you have a bunch of student loans, we can put those loans into forbearance, which basically means putting off you're having to pay them back for 12 months and 1 day from the date of closing, and we can get you qualified without counting any student loan payment against you. Those are the rules as of today, and they change often. So you want to stay in touch and in communication with a professional who can keep you aware of all the updates as they come up.
So if I'm in an income-based repayment plan, what is the effect?
Income-based repayment plans can be a little bit tricky if the monthly payment is less than 1% of the total balance and it also does not amortize or pay off the whole loan balance. Then we're more than likely going to be using the 1% of the total loan balance. This can make things a little bit more difficult for potential borrowers to qualify, but it doesn't make it impossible. So what you really need to do is get with a mortgage professional, talk them through your situation, perhaps provide a little bit of documentation regarding your student loans, and see where you stand and go from there.